Okay, good afternoon, ladies and gentlemen. I think it's time to start. I'm Grzegorz EKIERT, and I'm director of the Center for European Studies. So this is my seminar. We probably picked the worst possible weather for the seminar, the first sunny, beautiful day of the season. But of course, another problem is that our seminars are taped and are available online. So many of our friends who usually attended the meetings now do it at 11 at night with a glass of wine, watching the discussion on their computers. So anyway, this is the fourth seminar in a series we started this academic year, and we were looking at the different dimensions of crisis taking place in Europe. The one different thing about this seminar, in contrast to many other seminars, was that we decided to look at the events in Europe from disciplinary perspective. That was the idea, to broaden the discussion about the crisis and to hear many more voices than only the economists who were monopolizing the debates about crisis. You know, we had political scientists first, who were very pessimistic, as I once said, and all were dressed in black. So that seminar was called All Men in Black. Then we had sociologists who did something unexpected, happened to be incredibly optimistic about Europe and future, and sensing a big change in the right direction, and so on. Then we had a wonderful panel of historians who, as you would easily assume, had a longer perspective on events in Europe, and were not really very much excited about what's going on now, but sort of look at that in the longer perspective. And then in February, everything started to calm down, and I thought for a moment that maybe we should really stop talking about crisis in Europe. The patient was sitting still, all the band-aids all over the place, and suddenly, you know, everything fall apart again. And Cyprus showed up, and we have discussion about possible collapse of euro and possible collapse of the European Union, and so on. So, in order to help us understand the new phase of the crisis, we have three very distinguished colleagues who work on the border between academic disciplines, but also know a lot about the real economic life and real investments in global economy and shift of money and all those things. So let me introduce very briefly more information on their website. Susanne BERGER is a Dorman-Starbuck professor of political science at MIT. She's co-chair of the New Production in the Innovation Economy project. Suzanne has been associate of the center and friend for many years. Her work span, you know, all dimensions of comparative politics. In the past, she wrote a lot about interest formation in Europe. Now she works on globalization and political economy. Dante Rossini is a Simmons Faculty Fellow specializing in sovereign debt, monetary policy, central banking, and international investment, one of the great teachers of the Harvard Business School. Dante knows what he's talking about. He was a former investment banker for some 20 years, in the time this was very reputable profession. Now, RAWI ABDELAL is a Johnson Professor of International Management at Harvard Business School, and he chairs the MBA required curriculum, which means teaching many hundreds of exceedingly bright students. RAWI works on politics of globalization, international political economy. He focuses a lot on Euro-Asia. He's one of the most generous colleagues at the university. He is affiliated with our center, with Davis Center, with Center for International Affairs. And if you would like to see him the second time, he will be here again on Friday at the State and Capitalis seminar. So we are very grateful for your commitment to the center. The rules of the game, the rules of engagement for this seminar. So we'll start with the three relatively short presentations. Then we will try to have some kind of debate among the panelists if they happen to disagree on some issues. And then we'll open the floor for the discussion. After the seminar, we'll have reception upstairs, to which you are all invited. Just to remind you, we are all being taped during that seminar. So smiling nicely is a good thing to do. Let me thank Sadie Polen, Sarah DeLutte, and Paul Zeus for managing all the technical and bureaucratic affairs connected to that seminar. I'm very grateful. Everything was perfect. So Suzanne is our first speaker.
So thank you. I'd like to start by, I thought of a great title, though I wasn't quite certain if a 10 to 15 minute talk would get a title, but the title is The Great Disintegration. And what I'd like to focus on is the unraveling of Europe's economic links to the global economy and the politics of recomposition and recentering these economic flows within nation states. And so the first point about capital flows are the most powerful factors linking economies around the world. And in the period between 1980 and 2007, Europe accounted for 56% of the increase in global cross-border capital flows. And by cross-border flows, we mean things like foreign direct investment, lending, purchases of bonds and equities. By 2007, European banks accounted for about 3/4 of all cross-border bank claims coming out of developed economies. And in fact, since 2007, European lending has accounted for 3/4 of the collapse in cross-border lending. So there's been a huge reduction in European links, the links of European states to borrowers and lenders outside their own borders. And 2/3 of that reduction is in lending to other European countries. As Eurozone banks have pulled back from lending, what's happened is that they have increased lending within their own home economies. And so the question really is, how do we really want to think about this? Maybe from one point of view, you could think this is a pretty good evolution. After all that leveraging of financial assets, creating all these multiple exotic financial instruments, lending to all that building in Spain, lending to the Greek government, Portugal, all the rest, those were hardly very good investments for the lenders or really for the borrowers either. We know that the rules and regulations that govern these flows were grossly inadequate. And I think, looking at this enormous expansion or explosion of cross-border lending, we know from things like the Reinhardt and Rogoff book, This Time is Different, that periods of great explosion of cross-border capital flows are really quite likely to end in banking crises. So you might think maybe it's not so bad to have a recentering of these financial flows into domestic markets, at least for some period of time, while new rules and regulations get set into place. And what I'd like to argue is that I think this period of inward retreat may be far longer than any of us today actually expects. We have one previous big-time experience of this, and that's with the first wave of financial globalization, a wave that went from roughly the middle of the 19th century to exactly August 4th, 1914, after which it was no more and the borders all went back up. And at that time, many people really expected that, this cross-border lending, the global economy would resume after the war ended. But it did not. In fact, it really did not resume again for about 70 years. And it was only in the mid-1980s that cross-border financial flows and the integration of the international economy returned to something like the levels that they had been in 1900. So this was a very, very long time before we returned. And I think there are many reasons for this, and this period has been, the period after World War I, has been studied by people like Charlie Mayer, Harold James, Barry Eichengreen. But I think without returning to their explanations of that period, that we can already see at work within European countries today the kinds of political shifts that are likely to create much higher borders around domestic societies and economies and make the current disintegration of both the European and the global economies possibly quite longer and more durable than you might think. So I'd like to mention some of these political shifts, and if I focus on France, I hope you understand that I'm just like a student at the end of an exam that she does not have time to complete. I'm just screaming time, and really could tell you just as much about all the other countries as France, although it's really true. If we look at France, there's been a real shift in views about the nation in the world. So I was not surprised, and I don't think you will be either, to learn that in a January 2013 poll that only 39% of the French see globalization as an opportunity for France, and 61% see it as a menace. I mean, this is something that's been going on in France for a while. But I was surprised at the answer to the following question. It was this: for dealing with the big problems in years to come, should we give more power to Europe, even if that limits the powers of the French government? Or should we reinforce the power of the French government, even if that limits the power of Europe? Only 23% of those polled thought it would be good to give more power to Europe, and 65% favored giving more power to the French government. Well, it's no surprise that on both extremes, the Front National and the Front de Gauche, I mean, they were more than 75% in favor of something that looks like more national sovereignty. But if we look at the socialists within this poll, almost 60% of the socialists thought it would be better to give more power to the French government. And for the UMP, it was about the same numbers. So, I mean, this is, I think, really a pretty dramatic shift. And when you then look at the answers in this poll to questions about immigrants, questions about getting some leader who would show strong authority, questions about the trustworthiness of elected officials, what we saw in France in that poll, I think, is a kind of rampant rage and anger and lack of trust that really isn't so very different than what you see in Italy in Beppe Grillo's five-star movement, or something like the Poujadism that Stanley Hoffmann described more than 50 years ago as a recurrent French syndrome. So a kind of inward-looking, xenophobic populism inward within the country supports this kind of major shift, I think, in its economy. The second factor, and here leaving aside shifts in public opinion, I'd like to just mention two shifts in national policies regarding integration, and one in which I think we can see backsliding or disintegration. So Schengen, the agreements on having common single border level entry provisions for people entering into the European zone. These agreements from 1985, 1995 have been signed by 26 European countries. The UK and Ireland were never in, so let's even disregard their positions here. But what we've had over the last few years is a lot of a lot more objection to Schengen. Sarkozy said in March of 2012 that he would be pulling out of Schengen. He would pull France out by March 2013. Of course, Sarkozy himself is not around, but I mean, I think this is kind of symptomatic of what's going on. The Danes sort of closed their borders. The Dutch and the Belgians are citing corruption. The opening of Schengen to Romanians and Bulgarians is on kind of permanent hold. I don't know, whatever your worries may be about Cyprus, you may be relieved to know that Cyprus is not in Schengen either, and that doesn't seem to be happening very, very quickly either. So, I mean, the free movement of persons within the community was a very big point, and there I think we can see in a very uneven way, but still a kind of pulling back from that. But from my point of view, what's really most interesting is what's happened on banking. And here I know that Dante will be talking more about this, but I just want to emphasize that the one really important agreement that there has been on accepting a single bank regulator by March 2014 still leaves open so many questions about bank resolution, about common deposit insurance, that it's really not even certain that the elements of agreement, that is that there should be a single bank regulator at the European Bank for banks with more than a certain level of assets, that it wouldn't be almost more harmful to have this agreement if you than positive if you can't come to some agreement on the rest. So what about agreement on the rest? There have been two major banking reforms in the advanced industrial countries over the last few years. One, the U.S. banking agreement, the Dodd-Frank reform, and which incorporates a version of the Volcker idea of separating of forbidding banks, requiring banks to separate out, not to trade on their own behalf. And the UK banking reform, the Vickers reform, which would in fact put a fence around what's so-called safe retail and ordinary commercial banking, and require the banks to do their riskier deals in subsidiaries or other institutions. And so here are sort of two models out there, and in response to these two models, the EU set up a special commission. The Liikanen, he's the governor of the Finnish central bank, and so he has a proposal that looks like some kind of a mix between the UK and the US systems. So what's really kind of interesting is this proposal, the set of proposals from the expert committee, the Liikanen proposals came out in October 2012. And within 3 months, the French had not only proposed, but presented to the National Assembly its own reform, which is radically different than the Liikanen reform. The French announced that to adopt anything like the EU requirements would be, as the finance minister Moscovici said, it would be making a present to the Anglo-Saxon banks by allowing them uniquely in the world to have the possibilities of doing these riskier trades within the bank. The French banks kind of rose up in horror at the idea that anything like these Liikanen reforms could be imposed on European banks. And the Germans also very quickly passed another proposal for banking reform that went very far from the Liikanen report. So I think that even on something as critical to the Eurozone and to the European Union as banking, as how you deal with risk within the banking system, we're moving towards more national solutions. I think the question, and maybe we can come to this in the discussion, is there some way of using the fact of a return to a more domestically focused financial flows? Is there some way of trying to exploit this opportunity in a direction that could both promote more growth and that where there could be some measure of integration among the European economies. Is there some way of doing this in the face of the new populism that seems to be growing not only within the kind of obvious cases like Italy, but even within countries like France and Germany? Okay.
Great. Thank you so much, Suzanne. Dante.
Okay, well, Suzanne, first of all, thank you very much, Gregor, for the introduction. And Suzanne, I couldn't agree more with you. What I find interesting is that if Europe can't even get this banking union to really move forward, forget about the fiscal union, right, which is way more difficult. So, as Gregor said, for my sins, I was an investment banker for 20 years. When people ask me about my background, I mostly refer to my background as nuclear engineer before that. I try to not even mention that. But one of the things that the 20 years on Wall Street in the city left me is that I look at financial markets, just by default. And one of the things that I found interesting in the last, say, year or two is to look at the financial markets and to see some degree of discrepancy between what you could read by looking at, say, the Euro Stock 500, the Dow Jones, the volatility levels here and there, how some of the bond markets trade, which indicate, frankly, some degree of optimism. Certainly after the great scare of 2011, where the spreads became very, very elevated amongst Southern Europe and Germany, where the equity markets were under pressure. In the last year or so, things seem to have been happy. You could have made money in the markets by entering them, over the last year, and so I look at the situation, and I look at the situation in Europe. I say, well, there must be a discrepancy. Not that the markets, of course, have understand the truth. In fact, the whole point of the markets is that you can make money when you understand the truth better than they do. But the reality is that there is a discrepancy. And so I've been asking myself, why is there such a discrepancy? Why are markets so positive as of late? And my answer is that ultimately there is one person that they need to thank if we want to personalize it, and that's Mario Draghi, my compatriot. Because I think at the end of the day, without what the ECB has done, we would be nowhere near where we are, and I think the situation would be much worse. But the question is, now that they've done what they've done, is that enough? Or are we in danger of actually stepping back to a situation that looks again like the brink of collapse? And my concern is that we might go there again. And let me just say a couple of things. One is that, as Suzanne rightly points out, I think the key here is the banks. One of the key elements of this crisis that needs to be addressed in Europe in particular is the banks. And why do I say that? Let alone the fact that they're large, of course. They, as you know, on average in the Eurozone, banks have assets that are about 2 or 3 times the GDP of the countries, when they're not, of course, 8 times like in Cyprus, but that's a different story, or Iceland, right? But on average, they're 2-3 times. For historical reasons that are very clear, including the fact that there are less developed capital markets in Europe, and that companies have been relying, therefore, on lending from the banks much more, let's say, than the United States. But if you look a little bit at what some of the feedback loops have been for the crisis, you will quickly understand why the banks are right in the middle of that. So when we think about elevated levels of debt to GDP, for example, an elevated level of debt to GDP will increase the fear of solvency on the country itself, and therefore will make sovereign yields go up. But when sovereign yields go up, that make the debt servicing costs of the country go up as well, which in turn feeds back into a higher debt. So you've got one lovely, terrible feedback loop. The second one that one could talk about is the fact that, when debt to GDP gets elevated, you could think, obviously, that will foster fiscal austerity in the country. And as we all well know, fiscal austerity will make the economy possibly shrink, right? But a shrinking economy means a shrinking GDP. Just by dint of the division, your debt to GDP will go up again, and that will feed the feedback loop again. And finally, an economy which is under pressure, of course, will mean less tax revenues for the government, which in turn will feed the fear of solvency, and therefore, start that loop again. So when you think of the banks are right in the middle of all that, because at the end of the day, when the economy starts to shrink, the banks will make losses on their loans, and therefore will decrease the amount of credit that they provide to the economy, making that loop even worse, right? As the sovereign yields go up, banks will make losses probably on some of their holdings of sovereign debt, and therefore, again, that will make them want to sell those bonds probably, which will feed back on the value of those bonds. And then finally, again, the fact that there are fears of bailout by the countries of the banking system will, again, make things potentially even worse. So if you think what the ECB has done in all this, they started at the end of 2011 with these huge emissions of liquidity into the system, with these LTROs, right? Long-term refinancing operations. And therefore, they've tried to address the issue of liquidity of the banks and ability to put this money back into the economy. Not so successfully in many ways. One, because the spread started to come back again. Two, because the banks engaged in this sort of carry trade where they were getting this money for cheap by the ECB, and they were turning around and buying their own domestic sovereign bonds. And so that worked for a while, but not for very long. And therefore, Mario Draghi got out of his hat this latest trick, if you want to call it that way, of the OMT, and basically saying, okay, we will buy ultimately the bonds, even though we're not allowed to monetize the debt of any country. We will go in the secondary market and buy the bonds of these short-term bonds of these countries if we're asked to do so. And that has done the trick. So obviously done the trick. In fact, spreads have come down. And the euro, by the way, has been trading relatively strongly across the crisis, which I find quite extraordinary, because for a currency which was about to implode or explode, however you want to look at it, it traded at levels that were still pretty high, certainly versus the dollar. One could then argue, well, but the dollar was also under pressure, so if you have two currencies that are worth less, they will trade at the same level against each other. We could debate about that. I yet have to hear a really good explanation as to why the euro has now traded a lot lower over time. Anyway, the issue here to me is that this is all very nice, but if you look at what the Fed has been doing here, and they're actually out there in the market, they're buying the bonds in whatever form of QE you want to look at. They're intervening in the mortgage-backed securities market. They're obviously trying to keep the interest rate low in the long range, on the long end of the curve. And so they're in the market and they're operating on economic variables. The ECB is not in the market because this OMT has not happened. It's still theoretical. And B, it operates on a political variable because it has to have a request by the country. And so my question is, well, what happens if we get to that point and you actually have a situation where the ECB is faced between, intervening and saving a country which politically does not want to abide by the conditions? Because that's a possibility, right? I mean, the current stalling in Italy and the kind of populism that we see coming up is not particularly encouraging. There could be a position where the country is in trouble and yet the government is not willing to adapt to the conditions. So what do you do then? Is it too big to fail? Will the ECB intervene anyway or not? And I think those are questions that are kind of scary, to be honest with you. At least for me, they're worrisome as to how that could evolve, particularly at the time where you really have no signs from an economic standpoint of any growth in the areas that are suffering the most. And so you look at Greece, you look at Italy, and the recession is biting harder and harder every day. Greece is down now 20% of GDP since the start of the crisis. And there is no end in sight. And so the question is really how long can this system be under this kind of pressure before you get to a point where the ECB intervention becomes a key element of actually getting to the next level of safety? And so with that, I remain quite worried and still puzzled in some ways of how the markets can essentially be so optimistic in the face of a situation which I think is still potentially quite volatile and dangerous.
Thank you, Dante.
So this is all quite exciting, and I am reluctant to disagree with my dear friend Suzanne, and not just for the sake of the panel, but I think I have quite a bit more optimism about the way this might unfold, and in part because some of the very things that worry Dante seem to me to be quite promising signs. And so just to frame this, at least in my own head, one of the things that I've found quite extraordinary about this crisis is how it's a big one, right? It's a complicated one, but it's not Europe's first crisis. It's not its first major test from the markets. And in fact, what I see over the course of European integration is this history of inherently unstable equilibria. Each of these unstable equilibria tests the market's understanding of the credibility of the system. And they create opportunities for the markets to test individual national governments and the system as a whole. They invite the markets to make a variety of moral hazard trades and one-way bets against the system. And the markets have often been wrong when they have when they've bet against the system. So just a couple of decisive moments. I think one of them that's worth remembering is that European integration proceeded for 30 years without capital playing a large role in the project. And so the Treaty of Rome set capital aside from the other three fundamental freedoms as being not essential, capital freedom being not essential for the European project. It was only in 1986 and 1988, with a couple of capital liberalization directives under the Delors Commission, that capital received the same legal status as the other three fundamental freedoms. And so to me, what that means in part is that there is a great deal of the European project, of the acquis, that was created for 30 years without capital playing a large role at all, and which is probably not under threat. And so although there may be elements of capital's freedom that is under threat and cross-border capital flows within Europe, that is not what constitutes Europe. Europe is much broader than that. And so I would argue that there are lots of elements of the acquis that basically, unless there's quite a calamity, which is always possible, will be fine. One of the things that was quite important about that moment in when capital was finally liberalized after 30 years of European integration was that the Delors Commission was very keen that Europe retain the ability to keep the possibility open of Europe-wide capital controls. So those moments of capital liberalization for Europe were not intended to open up Europe to the rest of the world, at least initially, in the thinking of the Delors Commission. And it was only at the insistence of the Germans, and in particular Hans Tietmeyer, who insisted that if Europe were going to do this, it would have to do it erga omnes, toward all countries. And that really laid the foundation for Europe's financial integration to be a kind of global financial integration. All of this, though, these moments of capital liberalization, were in the service of a brilliant but very dangerous plan to lead Europe toward monetary union. It was a plan that was certain to produce financial instability, and they were well aware of that. And so even in the context of the standard understanding of the trilemma, in a moment when Europe had fixed exchange rates and independent autonomous national central banks who did not all have the same interest rate, the liberalization of capital flows created a very real possibility for financial crisis if countries did not fall in line and begin to follow the German interest rates as quickly as everyone else had done. The United Kingdom did not follow German interest rates, and it was no surprise that in September 1992, the United Kingdom was knocked out of the European monetary system permanently. Italy was knocked out for a bit, but came back. But this was well understood by the crafters of this brilliant but dangerous plan, that there would be casualties, and those casualties would be delivered by the markets when they did not believe in the credibility of national policymakers. And so one of the issues then was how to think about the movement toward this. And so another key element of this was the set of preconditions for monetary union that were laid out by Karl Otto Pohl, then of the Bundesbank. He said in his negotiations with Delors and his friends during this creation of this brilliant but dangerous plan that only 4 conditions would be necessary in order to move forward. One was central bank independence, another was capital liberalization, which they had just achieved, the other was a set of convergence criteria, which are now infamous, and the third was the obvious need for fiscal centralization of some sort. Pohl got the first 3. He did not get fiscal centralization. But the critical point here is that it was well known at that moment that some sort of fiscal centralization, if not outright fiscal union, was essential for the stability of a single currency. And so despite the misgivings of various commentators today, Paul Krugman being among the more famous, looking at the Europeans saying, oh, how could they be so silly to try to have a common currency without a fiscal union? Yes, of course they knew that at the time, and they took another calculated risk in the history of European integration to have a common currency with the knowledge that it would create the possibility for this kind of sovereign debt crisis within the context of the Eurozone. In fact, it was almost certain that there would be some sovereign debt crisis that resulted from the combination of this single currency with the inevitable reduction of bond yields across the system that would eventually lead somebody to get in trouble. And when that somebody got in trouble, of course, everybody would see that the next inevitable step of European integration would be in front of them, and that would be fiscal union. So I would not go quite so far as to say that this sovereign debt crisis was delivered by design, but it was well understood that something like this would happen. Now, nobody thought it would be this big, and nobody thought it would be this complicated, and nobody quite imagined that this tiny Greece 2.5% of the Eurozone could create quite such colossal instability in the entire system. But it was always clear that this could not be a stable equilibrium on its own, that there would eventually need to be some move toward fiscal union. And Tietmeyer at the time, in 1992 and 1993, described exactly what he had in mind, which is, he said, and I quote, "If you can withstand the test of the market, you have proven your stability." And so is this persistent testing by the market that Europe has mostly succeeded in achieving. And so one of the things that's quite extraordinary about this is that the markets are always posing this question to Europe, which is, how much do you mean it? How much do you mean it really? And in a way, the market's credulousness helped to deliver this crisis. So just looking at the fundamentals of the Greek sovereign over the past 40 years, one would be hard-pressed to come to the conclusion that the riskiness of lending to the Greek sovereign was more or less 25 basis points away from lending to the German sovereign. And yet that is exactly what the markets did, because they believed. They believed that it was real, and they believed that somebody would come and save the system in the event of a crisis that they, of course, helped to create, along with the banks themselves. It's very hard to have over-borrowing without over-lending, and the over-lending is an important part of this story. And so we go along fine until we have this moment of the reemergence of doubt on behalf of the markets, when it seems like, in fact, Greece will not be saved by its European friends. And so we have now a very fluid situation. I certainly agree with Dante that the decisive moment came with Draghi and the European Central Bank, saying basically we will do whatever it takes in order to save this system. And the markets have believed that, at least for a while. And there are moments of doubt from time to time associated with Cyprus, but they continue basically to believe that the European Central Bank will do whatever it takes until there is some more fundamental reckoning. It's a stopgap solution, it's a band-aid, it's unstable, it probably can't last forever in the absence of some greater fiscal centralization. But in the background, amidst these very complicated debates about banking system unification, there are these debates about a sort of fiscal centralization. There is, in fact, a kind of fiscal union that has been put in place. It's not great. It's mostly austerity-based. It has weak governance mechanisms, much as the Growth and Stability Pact had weak governance mechanisms, but it is a start. And I think when we look at the character of the solution so far, what we see is a great deal of alarm on a moment-to-moment basis. But over the grand sweep of this project and the purposeful design of these unstable equilibria, I think we have just one more defining moment in which an unstable equilibrium was produced on purpose with inevitable results that lead to an obvious solution, and the only question is whether Europe will be able to deliver this obvious solution or not. And I myself am quite optimistic about Europe's ability to deliver the next obvious solution. And if not, then we may be in for a moment of a real great unraveling. But I think we're not quite there yet. The Great Disintegration is not yet at hand, there's still a very real chance to save the project. So let me stop there.
Okay, great. Thank you so much. You know, this relates very well to the discussions we have in the previous panels. I think it achieved something which I hope for, that having a perspective from different sets of concerns and different professional commitments brings new ideas to the debate. I think that, you know, thinking about crisis in the most general way, I think that the number of arguments which are in place are either related to the markets. So you know, there is a line of argumentation that there is something about a horrible Anglo-Saxon markets which are trying to destroy very nice idea and very nice set of institutions. There is something about institutional defects. So you know, there's this line of argumentation that everything was set up with serious institutional problems, which people realize at the time, and RAWI sort of told us this story with a sort of, you know, a little bit different twist. And then there is an argument about politics, that there is something going on in politics, that those countries are not really responding, or EU is not responding in the way responsible politicians should respond to crisis like that. And there is, of course, the underlying argument about global repositioning of assets and resources across the globe, and you know, importance of Europe being declining over time and so on. And I wonder, you know, with those stories, how would you really characterize your positions on in that debate? Which of those factors you think, or which of those stories is really the most compelling one? Is it really crisis about politics? Is it really about, you know, this junction between market behavior and state behavior? Is it really about you know, the fact that those institutions were designed and set up in the wrong way?
Shall I? Okay, so I mean, I think that the piece of European integration that's about finance is special, in the sense that it requires the acquiescence of the markets and the belief of market participants in the project. Almost no other piece of the European project requires this belief of market participants in the outcomes. And so in that sense, this element, especially in an age of highly integrated and still global financial markets, the balance between the national policymakers, European policymakers, and the markets is the essential piece. I think the underlying that, though, is a political will that manifests itself within the elites of a handful of European nations. And so I think the more alarming thing for me would be the sense that one might have that the political will in favor of the European project by national policy elites may be waning. I would be much less alarmed by the opinion polls, frankly, in part because none of these things has ever been driven by widespread enthusiasm of mass publics in Europe. And certainly if they put the euro up for a vote across all of the European countries, they would not have voted in favor, and the Germans definitely wouldn't have voted in favor. It surely would have failed, and it was pushed ahead anyway. It's not obvious that the French would have rallied, and they very nearly didn't. It was a very close call in France. And so I would say there's been generally this, you know, what sometimes people call the permissive consensus of mass public, which is they don't mind very much. They don't much like certain things, but this is not their project, and this is not their priority. And then we've had this elite consensus that has lasted for a long time. So I think the big threat is whether the elite consensus breaks. And then there's a smaller threat, which is whether the permissive consensus becomes actually pessimism and skepticism. And so when we get down to the 20%, that seems less permissive, I would say. And so I think that's worth worrying about. But I'm much more worried about this elite level, because that's where the credibility of the project in the eyes of market participants is most tested.
Mm-hmm. Suzanne, would you?
So, I mean, I guess, I mean, I think we sort of agree on a number of things. I mean, first of all, banking everywhere depends on a certain kind of belief in that somebody will, I mean, banks operate by lending more than they have sitting in their coffers. I mean, banking is about leverage, and therefore, in order to work, requires belief that someone will come in and back the thing up. And what we had in the United States before there was somebody who could come in and back it up were a series of banking crises that only were resolved by guys going and, you know, J.P. Morgan taking people into, you know, rooms with cigars and locking them up there until they put the resources of their own private institutions into the mix. So the idea that there's some sort of belief here that's required on the part of the markets and some sort of institutions to back it up, that's generic to banking everywhere. I think the fact, though, is that what's different about the EU situation is that what RAWI calls a kind of permissive agreement of the public that this thing go on even if they're not terribly enthusiastic about it. First of all, there have been waning, there was more enthusiasm at a certain point. There has been a long downward trend. And if we look at what's happened, let's see, in one of the Central European countries, one of the central architects, really, Italy, I mean, we see what's possible when that permissive kind of consent really just breaks down completely. And so I guess what I was trying to suggest is that we're seeing in France a kind of erosion in public opinion, even of that minimal degree of enthusiasm or consent, and that the elite cannot help but looking at what happened to Mario Monti in Italy, but worry for its own survival. And so that's what seems to me a kind of danger in the current situation. Given that we now do have this tremendous reflux back into the system of banking resources, the national elites really do have a set of possibilities that they really didn't have before. They really do have the possibility of bottling the stuff up, bottling capital up within national borders. I mean, there's more potential there now than there was 5 years ago. So that's, I guess, the zone of difference.
I would agree with Suzanne, actually. I don't know, my big concern is, do we have enough time for the structural reforms that need to happen in Europe to get there before the whole thing explodes? And let me say this, I mean, clearly the democratic deficit in the formation of the EU is well known. You know, obviously, policymakers bulldozed over a series of things. You know, the Stability and Growth Pact wasn't respected by the very people who wrote it. Greece was pulled in by the hair, even though obviously, you know, clearly didn't qualify to be part of the EMU and so on and so forth. But in some ways, my concern is that we're now getting to a point where the numbers are kind of scary. So as I was saying earlier, you know, when you have 20% down GDP in Greece, when you have youth unemployment in Spain, which is currently 56%, you know, the question is no longer one of, is the demand side of the economy that's being touched, is potentially the supply side. You know, these are people who are not gonna get any skills, you know, and what do you do with these people after a decade? I mean, let's not forget we're now almost, you know, we're the second part of the decade, first decade of crisis here. You know, this is not going away anytime soon. And so while it's obvious to everybody that a breakup of the euro is absolutely impossible because the costs would be enormous for not only the small countries that would have to leave, and estimates are that, you know, their GDP would go down by 50% in the first year, or whatever economists think, but even the larger countries, of course, you know, face costs that are prohibitive. Nevertheless, though, on the ground, you know, people are suffering. I mean, things are not great. And so the question is, how far can you stretch from a social perspective before you get to a point where the crisis is upon us again, and with political pressures like the ones we see here in Italy. Now, don't get me wrong, I think there are positive elements. I mean, if you look from an economic standpoint, some of these countries are actually making changes that are positive changes, right? Current accounts are being, the deficits are being absorbed, right? I mean, you see, more expert, you see some reforms that are positive there, but the real heavy structural reforms haven't actually taken place yet in some ways, and I don't know that the political will be there. That's my concern. Do we have enough time? Will
Let me open the floor, please.
Thank you. I'm Bob Kuttner. Question for RAWI. You wrote the book on this, and I want to go back to an earlier phase and then italicize something you said and pose a question. So, if one listens selectively to your comments, you pointed out that markets systematically priced big things wrong for a long time, including the sovereign debt of the peripheral countries. And the reason that the original Bretton Woods system was set up is that one of the things that financial markets systematically priced wrong was the productive capacity of the real economy, which is why the post-war system began Reconstruction with significant capital controls, fixed exchange rates, etc. So you fast forward to the period of the crisis. Financial markets had priced wrong exotic securities. That triggered the crash. And then in the fall of '07, when financial markets realized that they had been too optimistic in their pricing of the sovereign debt of peripheral countries, you had a huge correction. And then at that point, instead of saying, well, wait a minute, maybe they're going to overdo it on the downside, just the way they overdid it on the upside, the European authorities, led by Mrs. Merkel, who succeeded Schroeder with a vow to impose fiscal rigor, both on Germany and in her role as hegemon of Europe, on the rest of the EU, said, wow, now we got them. We're going to let the market be our enforcer, and we're going to make these peripheral countries get serious about their books, about their borrowing, about all of this stuff. And we'll go from Spain to Portugal to Greece to Italy to wherever. The only problem is the patient dies. And I guess my question is, to italicize your point, that markets sometimes systematically price things wrong for a long time. Are markets mispricing the productive potential of Europe, aided and abetted by the EC, the ECB, and Berlin? And if so, what do we do about it?
So, it's good to see you, Bob, by the way.
Good to see you, Robert.
And just so nobody thinks there's any inside baseball, you also wrote the review of the book that I wrote. So,
and it was
the
a
definitive
rave
review, so
review.
indeed. And I still appreciate that. So, I mean, I think these are all exactly the right questions. I would say a couple of things. One is that it's not yet clear that the markets mispriced all of the peripheral countries. Absolutely. So I would say, I think it's fair to say they mispriced Greece, right? So if there has ever been a nation that actually is insolvent, it's Greece. But then we have a lot of other countries that are not, whose fate is determined by the market sense of them. And so one of the things that Dante taught me, as we've been talking about this over the past few years, one looked at Italy, for example, which has a primary budget surplus. So excluding debt obligations, Italy has a primary budget surplus. If everything can just be muddled through for a while longer, I don't know how much longer, then Italy has a sustainable sovereign debt position. No problem. And the markets have priced it correctly. They were wrong when the yields went up, but they were right when the yields were low if Italy stays in. And if Italy doesn't stay in, or if the whole thing unravels, then they will have been wrong. But if the thing stays together and the markets continue to believe, then Italy will be fine. If the markets fail to believe and Italy's borrowing costs go up, Italy will have a sovereign debt crisis with certainty. And so in some sense, the outcome of some of these nations that are not truly insolvent will be determined by the beliefs of these market participants. And that's why some of these actions by Draghi and others have been so critical at this moment, because they're not insolvent yet, but they could be made insolvent by the lack of credulousness of the markets if that went away. So that's one part of it. And then another part of it is the question of the political use of austerity by the Germans in the rest of Europe, which is a very dangerous game, right? It's a very dangerous game for the Germans. It's a very dangerous game for Europe in general. And on the question of for Europe in general, I would just defer to my good friend Mark Blythe, who has written the book on austerity called Austerity, which we'll be discussing here, probably in this room, on Friday. And I think the dangers of the political uses of austerity in Europe is an ideological question and a political question, but a big problem, but not necessary for the management of the crisis. It is in the realm of possible to shift the ideology of how to get out of the crisis, and I think it's reasonably likely for a variety of reasons, but that's a promise. I think the bigger point I would make, though, is, and I think going back to the Bretton Woods consensus, is exactly right, which is the one thing we've learned is that highly integrated financial markets are incompatible with global stability. That is the big lesson of the past 150 years. And if one wants to save free trade in goods and services, one has to have some freedom for flows of capital, but that doesn't create an obligation for capital to flow freely. And so just the retrenchment itself of banking practices is a good outcome for Europe and a good outcome for global stability. As long as there are some allowances made for capital to flow freely, it doesn't have to flow freely for the thing to work. In fact, it mostly shouldn't. And so to the extent that we've seen an erosion of the legitimacy in the belief of capital freedom in Europe and around the world, that is mostly a good sign if we save the belief in the legitimacy for freedom of movement for goods and services, which is not nearly as under threat as the legitimacy for freedom of movement of capital. And so Europe could achieve a kind of new Bretton Woods consensus that would be good for Europe, that would have fewer cross-border flows of capital without undermining some of the key elements of the acquis that at least at the moment, to my mind, are not at threat.
Professor Mayer.
Discussion for Margaret Thatcher. I agree with these analyses, but I just think, in some sense, by invoking markets and banking and capital, we do leave out some of the determinants of what you now are alluding to, and that is these terrible unemployment rates, this stagnation. It seems to me that somewhere around Margaret Thatcher came in, we switched to a type of preoccupation with monetary movement and aggregates, which in effect I think has tied our hands. It is true that we rewrote the history of the Great Depression so that it became the fault of bad inadequate central bank issues. So in some sense, I just wonder whether there isn't a fetishism, a preoccupation with how those who control capital are reacting, and that somehow Keynes said not only he also said only ideas should flow. He also thought goods shouldn't flow, particularly between countries. And I do worry about the momentum of restricting this. But I do think that with some degree of social imagination, if we look at these real costs, such as Dante has evoked, with public interventions, which is a way of saying austerity has not worked, and it's the wrong answer. We had a seminar just before this on some of the international flows, and in a certain sense, what the Northern Europeans say about the Southern Europeans is what the Republicans said about the Democrats. 47% dependency, pathological dependency culture. But of course, they are diffused over a geographical region, whereas the Europeans pile up the moochers in the south and the virtuous in the north. And this makes terrible social engineering. We could see it in the oil crisis with Texas and New England whatsoever. But I would suggest it would be nice if during these discussions we get fascinated by capital and its movements, but we really try and think of alternative ways of changing real variables, real public investment in some sense. And that requires debits, but as you said, Mario Draghi and other people can print money ultimately and can make these credits.
Someone would like to respond to that?
Yeah, I mean, just one thing there. I agree with you. I mean, I like your approach. Unfortunately, the markets are out there every day doing what they do, and they are pretty harsh and sometimes stupid, but they are. And so, if you look at Italy, for example, Italy honestly is a country which is not in as bad a shape as people think. Meaning that, as you know, I mean, certainly of all people. From the net international investment position of Italy is not that bad because its private debt is so low, savings are so high. So when you combine public and private, it's actually looking pretty good. If you look at the amount of assets that Italy has against the liability it has more than enough assets to cover all of its liabilities. Let alone the churches and the paintings, but I mean, actual assets, including, right? But the problem is that, investors are quite simplistic sometimes. They look at the country and say, okay, hold on a second, you have 120% debt to GDP, okay? That means that even if you have a balanced budget and no inflation, with an average cost of debt of 5%, next year you'll have 126% of debt to GDP, right? So, I mean, the concept of the spiral, right? I mean, there's a point where that evolution of debt to GDP will actually go up away from you and you can't bring it down. So,
raise raise the national income level.
Bravissimo, and that's exactly my point, which is exactly the point, which is Europe needs to figure out that Southern Europe needs help in getting its growth back, because that's exactly the point. You've got to get that denominator bigger, right? That's how you're going to get there. And so we need help. Europe needs to understand that it needs to help Southern Europe to get out of the mess where it's in. And it doesn't have to be through fiscal transfer. It can be through other ways, including, for example, a weaker euro. Let's figure out how to get this euro down, including, for example, a larger investment program. Maybe the EIB should be tasked with doing more, investing down in Greece and where have you, and maybe recognizing that in some parts of Southern Europe that is too high and that they will never repay it, certainly not in the timing that people think. But I think that's, we're not there yet.
I guess I'd like to come back to RAWI's idea that maybe some sort of new Bretton Woods, and maybe we really, that we should really seize the lesson of that high degrees of financial integration end up with, big crises, and that we would be able to keep some kind of openness for trade in goods and services without capital, without free markets for capital. And I guess I'm just concerned that as I try to think what happened to Bretton Woods the first time around. What happened to Bretton Woods the first time around was, that, well, first of all, you do need some sort of currency. If it's not gold, it's going to be the dollar. And so the United States, we cheated and, ran the Vietnam War and the war on poverty all on the back of other people. And then you could say the British actually cheated also by allowing the euro-dollar markets to grow up in offshore. It's hard to see exactly how we would be capable of rules, that would prevent that kind of thing from happening again. I can see the desirability, but I kind of wonder, could you kind of suggest how you think such a thing might come about that wouldn't inevitably sort of crash on the same? I'm sort of remembering, I'm not sure I have the words exactly right, Karl Polanyi saying about the gold standard, where Marx and Ricardo were in agreement, the 19th century knew no doubt. And I sort of wonder how we could push on beyond that point of agreement.
So you're on the spot, with that.
Yeah, no, absolutely. So, I mean, I agree with Charlie. It is sort of an embarrassing fetish that one, you know, to bring out in public, this fetish of the markets. But embarrassing as it is, and perhaps I'm a bit with Dante on this, part of the problem is that with a lot of cross-border flows of capital, perfectly sensible policy choices in which the markets don't believe cannot succeed. The ability of national governments to deviate from the preferences of market participants, whatever they are, is actually impossible. And so if the market participants don't believe and they begin pulling capital out, that policy, however sensible it might have been in moment X, if it's not sensible in the eyes of the market participants in moment Y, we're living in moment Y right now, it will fail. And so there is a real constraint based on the worldviews of the market participants. And changing the worldviews of the market participants is part of this story, in fact. And so I think to build on the nice Polanyi quote, which I'm very fond of, I mean, we're talking about a divorce of Marx and Ricardo again, in a way, and thinking through what it might mean to have a set of national policies, but also market practices that are more national than they are international. And it's really the market practices that would have to change as much as it might be the policies. Whether it would lead to moments of crisis, I think those are inevitable as parts of the system. And the question is just how big they are and how calamitous they are. And so, you know, we did not destroy an era of free trade that was building even when Bretton Woods collapsed. In fact, free trade in goods and services just went on about its business, even though it was quite a difficult moment in the history of the international monetary system. The European fixed exchange rate system, which came in a variety of forms over the years, broke all the time until we finally got to the euro. We'll see whether it breaks this time. I think it might not. But we still went about our business, as it were, with cross-border trade, even in these recurring moments of financial crisis, which maybe are just a part of any system that has lots of cross-border flows of capital.
Professor Higone.
As I listen to you, I see different explanations as to why we're in this situation. There's the banking explanation, there's the unemployment explanation, there's the political explanation, and we vote from below and the elites give up. So I'm just wondering, are we in a kind of 1914 situation where nobody really wants this thing to go wrong because we're all terrorized by what would happen? But what would be the sequence that you see as the most probable in this bundle of reasons?
Yeah, I can certainly.
Go ahead.
I can certainly offer some thoughts. I mean, I wish I knew. I guess it's really the answer. And I think that Europe and Europeans know what is needed. I don't think I'm under no illusion that there is no clarity in Europe as to that's actually what would work to actually get this thing solved. And in some ways they could have done this at the very beginning by writing a check for Greece, and we wouldn't even be here. But unfortunately, the question is how difficult is it to get there? Because even though it's kind of clear where they need to get to, it's very difficult to get there. And so to me the question is, what are the steps that can be taken in a credible, presentable way to the markets in particular, so that we can actually get to where we need to get as Europeans? And I think they could probably start going back to the question of the banks, for example. You know, we could certainly start by trying to figure out a way to get that piece of the puzzle solved. Because if we can get that piece of puzzle solved, that would lead us to some beneficial feedback loops, if you want, in the economy that would allow us to get to the growth that would take away some of this huge pressure that we're under right now to find some sort of a solution before it's too late. And then we can talk about the other issues about the potential ability to get to some degree of fiscal. I don't want to use even the word union, but of ways of getting to no longer have these issues where countries are on their own completely, where they can count. The famous blue and red Euro bonds proposal, things of that sort, where we can actually get to a point where the only solution is no longer just that of lending to each other under pressure with the certainty that this money has to come back anyway. And so, buy time, basically, because, but I think the solution is kind of clear. As Ravi puts it, I think Europe needs more Europe in order to get this sorted. Europe is still the largest market in the world. It's still a place that has an enormous amount of skill and potential, and it's kind of sad to see it blocked as it is now. Wondering if it's gonna explode at some point.
So I mean, I would agree with a lot of what Dante said. And thinking about this 1914 moment is a fascinating and useful discipline to think, in these broad sweep of the ebb and flow of globalization. I think to my mind, one of the promising things about our moment compared to 1914 is that 1914, that era of globalization, circa 1870 to exactly 1914, had no institutional underpinnings at all. A set of beliefs about how the gold standard might work, a set of beliefs about trade in goods, a little bit in services, and nothing else. And this time around, we have a great many institutional underpinnings. We have not only the European Union, which is probably the single most important driver of this era of globalization that we have, but also we have the International Monetary Fund, which pops up here and there during this crisis. We have the World Trade Organization, we have the OECD, the alphabet soup of international organizations that are very, not robust, but certainly meaningful institutional underpinnings with a lot of clever, very committed globalizers embedded within them, prepared to do as much as possible to bring us to the end of this crisis without actually unraveling the whole thing as it unraveled in 1914. But I prefer to think more probabilistically about a handful of scenarios and say, well, what is the probability that we're going to have more globalization in a few years than we did in 2008? No more than 10%, I would think. What is the probability that we have more or less the same amount of globalization with some more skepticism, some more constraints, but it's basically not a total unraveling? Maybe we get a bit less. I would say a good, 60, 70%. Let's say 70%. Then that leaves, 20% a probability we might assign to a real disintegration, which is, that's alarming. 20% chance of the world coming to an end is like a big deal. But I think it would be much higher if we didn't have these other institutional underpinnings with real agents who are committed to this project, trying to think creatively about solutions. And the stability bonds that Dante mentioned are one of these creative solutions. So there's this green paper, making its way around Brussels with this idea of creating bonds that would be issued on behalf of the entire Eurozone with joint and several liability for them. It's not quite fiscal union, but it would require some fiscal union afterwards, which would be the natural European way to do these things, which is to put in something that requires more Europe later on. But that's a very creative solution that couldn't possibly exist without these agents running around trying to save the thing. And so that's why I would skew the probabilities toward it's not the end of the world, even though there's a good chance that the world could come to an end.
Mm-hmm. Professor Koch.
So this is a very inspiring debate, like it very much. I do completely agree with what Dante said. If we cannot organize a growth perspective in Southern Europe, that will be barely manageable. I would like to talk lots about red bond, blue bond. If you would like to lose an election immediately in Finland, you should come up with that proposal. Or in Lombardy, if it's concerning southern Italy. So we have to think about why those brilliant ideas do not match policy-wise reality. But the main point I wanted to make, why I also agree with Dante and you, Ravi, why banking union is important, exactly because you're wrong in terms of the importance of capital flows within Europe. What we now see is, in fact, a resegmentation of capital markets in Europe, a renationalization to a degree which puts us back into the late 80s. In other words, which is not important for those poor investment bankers about who do not really care.
Whichever way they go,
capital. But which is really awful for medium-sized companies not having access to funds in any way. In other words, you're really undermining growth perspectives. So you really have an issue of access to funds there. And in addition to that, it makes monetary policy, actually they are running now 17 different policy rates. So it's a misfunctioning fixed exchange rate system which we are faced with. And that's why I would agree with you in terms of maybe it's not that a brilliant idea to have all these investment bankers playing around with I don't know what, but it's awful what we now have in terms of the capacity of medium-sized companies to get access to funds. There's a real credit crunch going on. Destroyed supply structure. That's the number one issue we should get a hand at, and it immediately relates to Dante's points in terms of growth. So monetary policy is completely dysfunctional, and Draghi, or the ECB, whilst being the strongest institution in Europe, is of course the weakest. They always have in this game of chicken to give in, come up with LTROs, OMTs, but that's not the solution going forward simply.
Gentleman at the back.
So just on this question of the technical and political potential to have this Bretton Woods 2 and capital controls and so on, it seems to me that we do have examples in the world where you have a combination of both financial repression or financial insulation and integration with globalization. But if there's one thing that the crisis seems to have taught us is that normatively, the fact that state solvency, democratic states, that their solvency has to be put at the behest of harsh and stupid markets, that has to change. Right? That's no longer sort of normatively an okay thing to happen. And so we have to think about ways in which both technically and politically that interface between markets and the structure of state funding has to change. And if you think of Japan, for all its problems, the Japanese fisc is insulated for all its globalization because of the structure of state funding. Right? And you have a degree of, call it optimal financial repression in China that achieves the same in India and so on and so forth. So there are technical ways. I mean, you don't have to discount all of European paper at the same rate. You can have different risk weightages without violating the sort of the unity of Europe. I mean, there are technical ways in which you can do this. So it seems like that is the space of exploration, finding new ways to engineer the interface between state funding and the markets or other institutions of funding, non-market-based funding, which as I said, Japan is. The question then becomes one of political will. What is the so there's a sort of theoretical imagination required to re-engineer that, but there's also a political consensus that's required to kind of get behind that. And so it's not, if we couch it in the terms of a return to Bretton Woods and broad-based capital controls, it seems like that political will might be attenuated. But if we couch it more in terms of a sort of optimal, don't call it optimal repression, but something else to redesign that interface, I think that we might get more political. So that's my question: is that yes, it would be great to have that set of, but where's the political will coming from? Surely, in order to generate space for the growth problem, you have to push back the markets, right? Because otherwise, you're not going to generate space for the growth problem to be solved. So if the policy leader doesn't realize this and sort of get behind this, might so that's a question.
Okay, would you like to respond to those two interventions?
I mean, the question about where the growth is going to come from, I mean, which is ultimately what somehow would save Greece. It's really hard to imagine what could work here without something like a devaluation. I mean, that would allow whatever it is that Greece could export, and that's kind of the problem about Greece. One's not looking at an economy that has an enormous array of things that the world wants, and without some sort of change in the level of the euro out there that would give the Greek economy a greater chance. It's really hard to imagine any solution that could achieve what you're looking at. I mean, Dante said something about if we had only been able to write a check to the Greeks at the very beginning, But then what would have happened? Then what would have happened next?
Some question for the Lehman that we were discussing earlier, right? So,
Yeah.
So I would just share a couple of reactions, and I think that I think indeed one of the challenges when we look at countries like Greece that look like they could benefit from letting go of the euro and devaluing and then sort of making their way out of it. I think one of the challenges is that Greece has been running current account deficits for as long as we've been keeping track of Greek balance of payments. And so it's not as though there are all of these economic activities happening in Greece that if only if only there were a drachma that was worth less, then there would be stuff happening. And so, I mean, I guess this goes back to Bob's point about the market's pricing of the productive potential of some of these countries. So if we look at, Greece and Cyprus don't have a lot of stuff they're going to export, whether they're in the euro or out of the euro. And that's I think one of the challenges. Like we would really need a major restructuring of some of these southern economies to put them on a footing to begin to grow. They're not going to begin to grow whatever fiscal policy they have, and they're not going to begin to grow whatever currency level they have until they undergo a very unpleasant transition away from the services-based economy that they've had towards something else. It's not so different from the United States when we think about what would happen in the event of a steep decline in the value of the dollar. The United States has been running current account deficits for a long time. If the dollar went down by 50% tomorrow, it's not as though we would have this great rebalancing because we've systematically been deindustrializing the country for a long time, and there's a limited appetite for our export of things like financial services or consulting services that might result from a devaluation of the dollar. So there's a lot of hard work everywhere in the world, including in the United States, to rethink what it means to be integrated with a global economy on a sustainable basis.
Mass amount of vouchers good for Mediterranean hotels.
Right.
I mean, there are different ways of
Well,
stimulating.
and I think this is related to this other point, frankly, which is that, yes, we don't have yet the collection of political imaginations that's required to think through this next moment in this era of globalization. But it's early going still, right? It took 20 years between 1914 and the early 1930s when Keynes and Dexter White began thinking through what a new thing might look like. And then another 10 years to figure out how to coordinate those understandings. And so I would agree. I don't think I want to try to sell your optimal repression story, but we can get somebody from the marketing department at Harvard Business School to work on the name of it, and we'll attach that to some set of political imaginations that don't yet exist. But I mean, if there's one lesson from the great ebb and flow of globalization over the course of the 20th century is that these political imaginations get created. And yeah, sure, we don't have them yet, but it's early going still.
And also, if I can just add one thing, I mean, I think some of the incentives for a country like Greece to leave the euro in order to rebalance itself are actually going away. One of the consequences of the wrenching internal deflation that they've gone through, or they're going through, is that things actually start to look better, right? I mean, the current account deficit was 18% in 2007. It's now almost balanced. The primary surplus is in sight. They might actually get to a primary surplus. The wage costs have been slaughtered. The unit labor productivity is coming back. Competitiveness is coming back. So, it's going to take a long time. Don't get me wrong. And this debt is still gigantic. And it's like a Damocles sword on their head. And that's where Europe needs to do something about. But they're trying damn hard. And so some good is actually coming out of this if we can get to the other side of the river before we drown.
Madam, I saw your hand.
One last question, because you did mention the blue-red bonds and how politically feasible, unfeasible they are for different countries. And as well, you mentioned the Italian debt, the Greek debt, etc. There have been a lot of, if you look at the continuum of what you could do in that respect, there's anything between people who consider that a banking union with the ESM, OMT are sufficient, to people who consider that anywhere between debt socialization through the red-blue bonds or some form of the European Redemption Fund, which is suggested by the Germans, is really the way to go. So I was just wondering, where on that continuum continuum are you, and how likely from a political imagination long term is moving towards desocialization in Europe?
Well, listen. First of all, I think that I'm agreeing with my colleague that at the end of the day, any discussion of fiscal union of any form at this point in time is just premature. I think with the German elections coming, frankly, if you go to Germany, no politician in their right mind would even want to pronounce the word, however you say it in German, fiscal union. I also think that the kind of ad hoc measures that have been found with the ESM, the FSF, and all that have been patched up by politicians who were working at a certain speed, which is their own speed, while thankfully the ECB was running at market speed and therefore could kind of bridge the politicians as they were coming up with these thoughts. But we are in a situation where, frankly, whatever measures they have together are not going to be enough if Italy shows up at the door and says, I've got a problemo. I really don't think it's enough. We need to get to the next step here. And I'm not sure that we're ever there. And frankly, even going back to the OMT, it's fantastic. But can you imagine a world where Italy is knocking at the door because they need the OMT to get them out of? I think it's going to be pretty ugly. So we're back to the credibility point that Ravi was saying about markets. The fiscal union has to be the solution long term. Whatever step we could take to get there, in a credible way, will have to be implemented. I don't know which is the next one that works, but as we are.
Andy?
Well, I guess my question pretty much addressed primarily to Dante, but I guess everybody. Early on, and even now, expressed concern that there might not be enough time for all these things to happen. I thought that there was a kind of a tension between two kinds of things that you suggested needed to happen, distinct from the institutional changes of the EU fiscal union. Money to the southern countries in the forms of not transfer, as you said, I think, but investment from banks. These are the kinds of things that would increase demand and hence growth, and hence improve the relationship between the denominator and the numerator. But earlier on, you also talked about the time needed for structural reforms. And I really would like you to say a little bit more about what you mean, what kind of structural reforms, and whether, it's a multi-part question, I'm sorry, and whether the markets are so much worried about structural reforms or growth, or the growth potential. Finally, whatever the list of structural reforms would be, and I take it you include things that would affect the labor market, in particular labor costs. If all the reforms that would be on your list would be carried out and they produced primary surpluses in the budgets and positive current account surpluses, what would the aggregate demand throughout Europe be the result of all these successes of structural reforms? How much demand would it result in? And how much unemployment would it consequently reduce?
Okay, well, I think that, so going back to this question of giving money, just as a couple of numbers, when, to show how severe the stress was in the southern banking, when the ECB came up with its trillion LTROs at the end of the year, 41% of that went to Spain and 25% of that went to Italy. So that's where it went. And even today, if you look at how the banks finance themselves and how dependent they are on the ECB, those numbers for Southern European banks are way higher than anywhere else. And that translates into this monetary policy fragmentation and difficulty in transmission of monetary policy, which means that a competitor in Italy, even if he's equal to his competitor in Germany, will pay between 4 and 6% more for its cost of capital. And that alone will, kill you in terms of profitability. So the issue of structural reform is well known, I think, and has just been stuck into local politics and into local interests. And perhaps this new revolution that Italy is showing with this, Grillo and what that means is an indication that things might change. But clearly, labor market reform has been, they tried, by the way, during the Monti government to do that, and it's been extremely difficult. They've made some progress on pensions in particular, but it's still there. It's still in Italy. The vast majority of companies are below 15 employees because as soon as you go above that, you can't fire the people. And so,
How would all that add up, if you could do it all, how would that all add up to growth and growth?
well, I think you would add up in terms of people finally making investments. And by the way, it's not just labor market reforms, right? It's a lot of the tradable goods reforms, competition in there, service competition. I mean, we can add many of these. Judicial reform, right? It's getting corruption perception index down, ease of doing business. All those indicators need to get to higher levels in Italy in particular, but certainly in Spain, in Greece, and what have you. So what that translates into ultimately is people investing, which are now not doing. They're not now doing. Those are private individuals, companies. FDI in Italy is terrible. People don't go to Italy. They have the choice to put a plant somewhere. They think about it. And even though Italy has got many beautiful things, shall we say, the truth is the climate is so difficult that people have not invested. So hopefully that will foster the investment that is needed in order to get to the growth. Now, my issue is that I don't know how to quantify that. I don't have numbers for you, but my concern is that it takes a long time. And so even if the numbers might be attractive, is how long is it going to take?
And suffering.
Right.
And political consequences of that.
Exactly. And the supply side that gets affected, as I was saying earlier, not just the demand.
Okay, RAWI.
There's a question over there, I think.
Well, we can take more.
Okay, why don't we take a few more questions? You are very short. We have a few more minutes, so please.
I was wondering if you had such European funds that you could invest in kickstarting growth in the south or in the periphery or whatever you want to call these places, what would you spend it on? Where is money really the limiting factor as opposed to institutional reform and so on?
Mm-hmm.
Were you suggesting that the climate itself in Southern Europe has deteriorated in recent years to the extent where corporations are reluctant to build plants or to sustain plants? I mean, has the temperature literally risen? I mean, is that what you're talking about?
You meant the investment climate.
No, I think he meant the temperature. That's my question.
Okay.
The heat. Yeah. Is it oppressively hot? Global warming. Yeah.
No. I meant the investment climate. Yeah.
Absolutely.
Investment climate. Yeah. The companies have been reluctant to go there because they find it difficult to enforce contracts. They find it difficult to hire and fire people. They find the bureaucracy is expensive. And so these are the kind of reforms that are needed in order to make things.
Let me ask one more question. Now, the Polish foreign minister recently had this very dramatic speech when he said that joining the Eurozone is in the vital national Polish interest. And of course, had he said that before the election, that would be total disaster, but it's still a couple of more years to go, so he can say things of that sort. But he was really very genuine about this. And I think the question is, what kind of EU is going to emerge after the crisis, right? Because the way he sees that it's going to be a very divided EU, with groupings of countries, some very much integrated, some outside of the decision-making process. So there will be Eurozone, there will be Schengen countries and out Schengen. There will be those who are out of Eurozone who will have no voice in most of the important issues. And then, of course, there is a neighborhood and the story. So I wonder, how do you think that this crisis, instead of producing more integration, really has the potential of produce really much if not disintegration, at least much more divisions within the existing EU. Okay, and we have few more minutes, so you may choose and pick a return to some of the issues from the discussion.
Just very quickly answer your question for what I can think of. I mean, I think the issue is, as you say, it's not one of money, meaning that money can be printed at the end of the day if you need it. The question is really one of stimulus. Is one of continuing to stimulate this economy from a fiscal standpoint as well as from a monetary standpoint. And that's my point about investment. Is, it almost doesn't matter when you have 56% unemployment if I don't want to rephrase Keynes, because if you make a hole, have people pay people to make a hole and then fill it again, it's still better than doing nothing. And the AIB can provide for funding in a better way than some of these local banks whose funding is so tied to the sovereign.
I would just say that there are two kinds of time rolling out here. There is the time in which the national elites or the European elites try out different solutions, and that seems to be really taking a very long time. I mean, we're 5 years past 2008, and even some of the basic pieces to which national populations would have been really pretty indifferent, like banking reform, I mean, would not have been terribly upsetting to anybody one way or the other, I don't think. So it's taking a long time. RAWI has talked about how long it really took before we had Keynes and something like Bretton Woods, but I think political times, that we're running out of time politically, that when you look at what's happened already in Italy, and the degree of kind of shifts in political attitudes in France and in some of the other countries, that these are just altogether different timetables, and that we may in fact run out of the political time we need to come up with the kind of reasonable and rational solutions that the architects of the European system might have had in mind. I guess I'm still thinking with a little horror of what the first thing RAWI said, which was they really planned it this way. They knew it would happen. And I sort of think, oh my God, if this is really true, what irresponsible people, because the thought that you can ride the tiger, the thought that crises like these or like the 1930s are ones in which you can really count on being able to come up with something like a New Deal and not end up with something like fascism. I mean, that's a greater set of risks than I really think you really want democratic politicians to be taking.
So I'll just share a couple of thoughts, although not quite as focused on fascism, although that's something to worry about too. On the pure economics of this, I would just say a couple of words, and they're related to just how we think about what the globalization of financial markets allows sovereigns to do, or nations to do generally, which is to say, if nations are allowed to run large current account deficits, they're only enabled in that prospect by financial markets that allow capital to flow in. And so if there were no globalization of financial markets, nations more or less could not run persistent current account deficits. And so it's a lot of rope with which to hang yourself, these financial flows. So then you look at a nation like, not to beat up on the poor Greeks anymore, right? Just the United States. The United States, like many of the Southern European countries, has been running large current account deficits for a long time, which means it's been systematically borrowing from the rest of the world trillions of dollars of capital. There's nothing wrong with borrowing on its own for a nation or any other unit, a household, a person, a corporation. There's nothing wrong with it inherently. The question is, what is your theory of your borrowing? What are you doing with that money? In the United States, at least, we did something rather Greek with it, which is that we had the biggest party ever for a long time without investing very much at all in our productive capacity. So our theory of borrowing for many, many years has been to have a party. The Greek theory of borrowing for many, many years was to have a party. There was no foreign direct investment. There was very limited domestic capital investment. They just spent it. So then it's not really the case that Greece's GDP was really 20% higher than it was today. It was fictional because it was based on that practice of borrowing and not because they were selling things to the rest of the world. They were just borrowing it. And so in some sense, when we look at the reckoning that is facing the United States, it's not so different from the reckoning that's facing much of Southern Europe, which is adjusting to the fact that there is no more borrowing to be done. And the previous theory of borrowing was bad. And there are consequences from that, and they're inevitable consequences. And even the most Keynesian stimulus promotion fiscal policies could not have avoided that reckoning. And that's the fundamental problem. And you look at other countries that dealt with this reckoning in different ways. Latvia, tiny Latvia being a curious example, where basically they woke up one day and they announced that all of the wages were going to be cut by 25% overnight. It was quite unpleasant. Unemployment went above 20%. They did it very quickly. The Greeks are taking a much longer time to achieve the same result. But that kind of internal devaluation, in the absence of an external devaluation, is really the only way to go about it, in putting labor costs at a sustainable basis, knowing that you will not be able to borrow to finance consumption, which is what Southern Europe has done and what the United States has done. And so that, in some ways, regardless of the policies, that reckoning was inevitable, and it's unpleasant, and it's very, very unhappy. But some of it could not have been avoided, unfortunately. And then I think this last point is really the most fascinating one, which is that the Eurozone, the solution to the Eurozone's problem is more Europe for the Eurozone. But this is why the Poles and lots of others are so worried about it, why the Baltic countries were so desperate to get into the Euro, which is now we know. We've been worried about two-speed Europe or multi-speed Europe or a core and a periphery for a long time, and now it's permanent. There will be, I mean, unless the Eurozone blows up, but if the Eurozone doesn't blow up, there is a permanent two-speed Europe. And this is the last moment that the peripheral nations will have to either be in and make their bet on that, or be out, probably for a long, long time. And that's, I think, one of the fundamental problems.
Dante, would you like to?
I never speak after RAWI.
Okay. Thank you so much, Suzanne, RAWI, Dante. Thank you all for coming. There is reception upstairs to all of you are invited. Thank you so much.